Markets continue to remain where they were. It's clearly under pressure today, and Nifty is below that crucial level of 7,500, about 43 points or lower, 43 odd points lower. Sensex is also down about 146 odd points as we speak today. Now, this is despite the fact that now the expectation of a possible rate cut is really picking up pace because of the kind of macroeconomic data that we've got yesterday. It was the inflation, both CPI as well as WPI, and both seem to be under control, at least for the moment. To help us analyze them better and what should one really read out of these numbers that have come out, we are now joined by Aditi Nayar, senior economist at Icra. Thank you very much, Aditi, for being with us here on NDTV Profit. It's always a pleasure to have you on the show. Firstly, two numbers that came out yesterday, and then I'll talk about the number which came on Friday. So talking about inflation first, what does it really tell you? The expectation, of course, is now building up of a rate cut. What is your key expectation? How much and when?
Thanks, Hina. Certainly, both the inflation numbers yesterday were softer than expected, with the WPI remaining steady at minus 0.9%, and the CPI inflation actually coming down quite strongly to 5.2%. I think what's really crucial is a couple of factors as far as the CPI is concerned. One, at 5.2%, the CPI headline is now only slightly above that 5% target for March 2017. And secondly, even though core inflation actually posed an uptick yesterday, core CPI that is, even then it remained around that 5% mark. So I think these are two very crucial aspects. Of course, food inflation has eased for both the CPI and the WPI, and that has helped the numbers to come out where they have. Going ahead, food inflation obviously always remains a tricky subject in a country like India. At this point in time, I think with what we got from the union budget in terms of the recommitment to the fiscal consolidation path, plus the softer than expected CPI numbers yesterday, as well as a contraction in the IIP for 3 months in a row, particularly after the one-off factors have gone away that really impacted that index in November and December. I think all of this does point towards a 25 basis points cut on policy day in April 2016. Beyond that, I think there's going to be a lot of factors that we'll have to watch out for. Not only the monsoon, which we do every year, but really what is going to be the impact on domestic demand after the pay award leads to a hike in salaries and pensions for central government employees. I think we can't really underplay the risk from that at this point in time. And therefore, I think after the 25 basis points cut that we're expecting in April, we may well be in for a longish pause while the RBI assesses the impact of the pay commission as well as the monsoon on all the other factors that impact food inflation.
Right, so a 25 basis point cut in April, but if you could give us a sense of or an estimate that you have for the remaining half of the calendar year, are you expecting, because even the US monetary policy, US Fed's monetary policy review meet is also starting, so cues from them, the global factors that are at play as well, taking into consideration all of those and a possibility of a better monsoon this year, how much more can we really expect from the RBI side?
So, better monsoon definitely is the baseline expectation that we're going with, but we'll also have to see what happens as far as food management is concerned, minimum support prices are concerned. Even with what possibly is a slightly optimistic advance estimate for the Rabi crop for pulses, we still have a domestic production in 15-16 that's expected to be a fair bit lower than the peak in 13-14. So pulses prices are not going to come off very substantially, I should say. They have been ticking down, but I don't think we're going to get a very sharp correction, and therefore making sure that imports are well planned and supplies are well planned across the country is still going to be important. So I think a lot of domestic factors, even on the food side, are still going to be quite crucial. So after the 25 bips cut that we are expecting in April, I think the maximum that we could hope for would be one more 25 basis points cut, if all the other conditions come together in a virtuous sort of circle.
All right. Talking about the rural part, the rural slowdown that we've been seeing in the country, that has been there for quite some time. In the budget, the finance minister gave a proposal that, they would be, the aim is to, of course, double farmers' income in the next 5 years. What's your sense that you're getting? Is it going to be via a hike in MSP? That was the case earlier, or there are going to be some other routes probably that the government would be taking? If that is so, if MSPs are hiked to make sure that that happens in the longer run, then are we likely to see a significant hike in inflation as we enter into the year 2017?
So, this is certainly going to be a tricky thing to balance out. How do you make sure that farmers' incomes go up without really stoking a first or second round inflation? So, I don't think that the entire answer can be through MSP. Certainly, a lot of other productivity enhancements and other measures would also need to be looked at to be able to achieve this goal. I don't think it's going to be very easy or certainly a very non-inflationary process.
All right. And what's your target for CPI and WPI in the near to medium term? How soon, firstly, can you expect WPI to enter into the positive territory?
So, WPI I think is certainly going to remain negative in March, and maybe over the next 3 to 4 months subsequently we could see it come back into the positive zone. As of now, we are working with a baseline expectation that the WPI would average around 3% in 2016-17. That's as compared to our expectation that the full year would be at minus 2.5% for 2015-16. Part of the reason, of course, is that food inflation, particularly at a time when the pay commission may boost the demand for food items with higher nutrition content, like pulses and vegetables, fruits, etc. We do think that even with a good monsoon, food inflation will be at least 5 to 6% in 2016-17. And while that has a bigger impact on the CPI, it also does have an impact on the WPI. Also, sugar prices are on their way up, so that's another factor that would impact food prices on both the indices. The base effect for some of the commodity items would go away. Also, we have seen some commodity prices strengthening in the last couple of weeks. That would also push up the WPI, and again, whatever is the trajectory of the INR would impact the prices of imported goods. So all told, we're looking at around 3% kind of average WPI for 2016-17. CPI as of now, assuming a normal monsoon and taking into account the budget proposals, but at the same time assuming that there would be some uptick in domestic demand post the pay award, we think that CPI inflation would average around 5.5% in 2016-17. So upshot of this would be a higher nominal GDP growth as compared to what we got in 15-16, and deflator that would be positive.
All right, so that was about inflation. How are you reading the IIP number that has come out as well, remaining in the negative territory? I mean, we know that, there were some seasonal concerns that were there in November, December. But now, how would you look at these numbers and what do they really indicate?
We were hoping that particularly with the uptick that we got in the core sector growth, that at least we would get a marginally positive growth from the IIP in January, and the fact that it has contracted and by a shade worse than what we got in December is certainly disappointing. A couple of things. One, of course, with the base effect going away, the very high growth of consumer durables has now come down to a moderate growth. I think that's something that may continue over the next couple of months, and that's certainly going to take away that big sort of factor that was pulling up IIP growth in the last few months, or at least making it less negative. The other thing I think that is really disappointing is that when we look at the breakdown of manufacturing subsectors in January, 10 contracted, 12 expanded, but in terms of the weightages, it was reversed. So the subsectors that actually did record an expansion in manufacturing have a smaller weight in the IIP than the subsectors that actually contracted. So I think that breadth of sluggishness that we're getting is also a concern, particularly given the fact that, as you said, the seasonal factor from November was not there, in terms of fewer working days, and the impact of the Chennai flood should have been far less in January than what we got in December. Also the Haryana agitation, that's something that may come in and have some impact in February. Even that factor was not there in the month of January. So I think overall, base effect notwithstanding, I think it is a bit of disappointing news, and 3 months of contraction in a row certainly doesn't bode well in terms of the overall number that we may get for the manufacturing GVA for Q4 either.
So does it mean that something probably is not going right as far as the need for a pickup in manufacturing is concerned, and probably a push is required on that front still?
Yeah, I think there's a couple of things. Firstly, we've had many discussions on this. Is the IIP index really capturing the growth in some of the sunrise or some of the newer sectors? It is an old base. There have been problems with it, particularly the volatility related to capital goods. And we are looking forward to the new updated CPI, which we hope is going to be released over the next few months. So perhaps the new IIP index is going to provide a much more updated and a much more data which is going to be closer to the ground feel. It's possible that some of the data anomalies will go away once we have the updated base for the IIP. At the same time, it is hard to kind of really look at an IIP which is contracting for 3 months in a row, and the manufacturing GVA growth, the value addition, which was as high as it was in Q3. Both the matrices are capturing different things. One is looking at value addition, one is just simply looking at volumes, but at the same time, they're painting a very different picture. So I think there is some amount of discord or dissonance that these two sets of data are bringing out. I think that as far as manufacturing is concerned, certainly there are some structural or some bigger picture issues right now. One, of course, rural demand is not very great. That is something that may turn around if the monsoon is normal. And secondly, in any case, with the pay award, we do think that at least lower ticket size consumer durables will get a push and will benefit from this stimulus, which is anyways going to come in terms of higher disposable incomes for a large number of households after the pay commission. Also state governments would probably over the next 2 years in a staggered manner come out with their own pay commission. So that again is something that would be sort of once in a decade kind of stimulus which would be coming in and would support the manufacturing sector and some other sectors. So, these are factors that will prop up manufacturing to an extent in the near term. Exports, perhaps, they won't contract as much as they have in 15-16, but I don't think that the global situation is painting a very optimistic picture for exports.
Right. So we've pretty much discussed all the macro data that we've got. But one last question I want to squeeze in here. What's your view on the currency? Because now even Rupee has been pretty volatile. The way it was moving towards that level of 68.85, and then it went past 67 to the dollar. Where do you really see that moving in the near term?
So, currencies are notorious for overshooting in either direction, and I think we've really gotten a lot of volatility of late with the INR. Because of both global factors as well as what's happening, domestically in terms of the event, which was the budget, and the expectations that had built up prior to that, and then of course the actual recommitment to fiscal consolidation, which was a bit of a relief. I think when we look at the next few months, on average, the rupee would possibly depreciate. And that would help bring the RER into balance as well to some extent. That definitely is something that as far as exports are concerned would provide some relief as well if the rupee were to depreciate, not only against the US dollar but against a slightly wider basket of currencies. So I think overall that would be the average direction. Of course, we may have the kind of volatility that we've seen in the last couple of months where the currency moves sharply in one direction and then retraces its steps.
All right, Aditi, we'll leave it there. Appreciate you joining us here on NDTV Profit for a very comprehensive view on the macro data that we've got so far. Thank you very much for joining us.